What's up, everyone? My name is Derek Vandelander. I am the owner of Trader Society, and if you're new to Forex, this is the video you need to watch. So what I'm going to be going over in this video are basically the things that I wish I had known when I first started trading. It's a base of the things that you should be doing to get started and to take your first step into the Forex market world. So let's get started here. So one, I want to thank you guys for being here. I have so much in store and things planned out for what I'm looking to do with Trader Society. And my main goal is to just honestly provide value to you guys so that you guys can get that feeling that I had when I started 6 years ago. The feeling that you don't know what you want to do with your life. You don't know what you're going to do. And what Forex did is it gave me so much hope because I saw the light at the end of the tunnel. This Forex absolutely changed my life. I went from looking for change in my couch so I could fill up my Honda, my old ass Honda, to literally this month was my first six-figure month, and that's just crazy to me. It's only been 6 years. And I just had my first six-figure month, okay? Like, that is the power of this industry. And it's taken, it's taken so much to get to where I am. But that's what I'm trying to do within this course. And there's 24 videos in this course. And basically, it's going to be a subject by subject on the things that you need to know within my strategy, the way that I trade, that I'm going to be teaching you. So I'm super excited for this. I put a lot of work into this, and I am severely ADD. So I don't think you guys understand how hard this was for me to put this together, but I can't wait to get all the information that I've gained in the last 6 years to you guys. So let's get started here. First off, what is Forex? Forex refers to the marketplace where various currencies and currency derivatives are traded. Basically, what we call Forex is the foreign exchange. The Forex market is the largest, most liquid market in the world. Way more liquid than crypto, way more liquid than the stock market. Now with Forex, I mean, they're doing trillions of dollars in volume a day. That's just insane. But what that means is you have so much opportunity in the Forex market to make money, and that's never going to end. And that's the amazing thing behind it. Forex has no centralized location. It's basically an electronic network of banks, brokers, retail traders, institutions, basically just trading against each other. Most of the people trading are trading through either a broker, like you'll be doing, me as well, obviously, but or banks. Okay, so the retail traders mostly they trade through brokers, okay, all the time, excuse me. What do you really need to know about Forex and how to get started? So I kind of gave you a little blueprint right here of the things that you need to know before you even get started on learning a strategy to where you become a profitable trader making money in the Forex market. I want you to know, if you're here and you've never really learned about Forex or you're kind of confused about it, I want you to know it's really not as scary as it may seem. Now, at first, this is going to feel very, very foreign. I remember feeling like I was learning something that was totally foreign to me. I was way out of my mind, didn't know which direction to go, and somehow I pulled it through to where I am, but I didn't have the luxury of having a solid mentor or somebody that educated to me the point that I'm going to educate you guys. I want to cut your learning curve way down compared to what mine was. So the first thing you're going to need to know is, what platform do you use to trade? So you're going to be learning throughout this course. There'll be a specific video for the two platforms that I trade on, which is MetaTrader 4 and TradingView. So I use MetaTrader 4 to actually place my trades through my broker. And then I use TradingView to mark up my charts so that I can know what the market's doing. And again, this may be way over your head, but it's not nearly as scary as you may think it is. So you'll need to know how to use the platform that you'll be trading on, which there'll be videos on this, on the platform, which are going to be coming up after this video right here. What is a broker? Picking a broker so that you can practice becoming efficient with the basic needs of Forex terms. Finding a mentor or educator that can help you get started on the right path. If you're here, I'm assuming that you want to learn how I trade. But maybe after you're done, you find that this strategy might not be for you. Totally cool. Find somebody, do your research on an educator or mentor before you choose which person you're going to use. You guys need to understand what it's going to take to become a long-term profitable trader. Is my goals for you guys, where you can live off of this practice, okay? You'll need to know the very basics of Forex, which obviously I'm going to be teaching you guys, and then understanding that it's going to feel very strange at first. It might feel just totally different, but if you have this inclination that you should be doing this, you guys got to go all in. This thing changed my life. Forex changed my life. And if you don't know where you're headed at in life right now, this could definitely be an avenue that changes your life 100%. But I want you guys to know that if you're going to do this, you got to take this very serious. You can't go half in with this stuff. You got to go all in. And that's what I'm going to teach you here. So what you need to do is you need to get set up on a demo account with a broker. So your first step is getting set up on a Forex broker. Now, what is a Forex broker? So a Forex broker is a financial service company that provides traders access to the platform for buying and selling currencies, okay? So transactions in the Forex market are always between a pair of two different currencies. A Forex broker might also be known as a Forex retail broker. So the broker that I use is called Hey Forex. The link's going to be in my bio below, or you can just go to heyforex.com. And the reason why I love Hey Forex is I've been with them ever since they opened up. They've always been very good to me. They've always helped me very quick. I've withdrawn over 6 figures with them. Money came very fast, under 4 hours. Now that's not always going to happen, but they've been very good to me. Okay, so you can choose any broker you want. I use Hey Forex because they've been good to me, and I know how they run the operations around there, and I trust what they're doing. So pick a broker, get set up with a demo account. If this is very confusing for you, one of the videos here coming up is going to teach you exactly how to do that. So don't feel too overwhelmed. That's what you need to know right there, and that's the first step. And the reason to get a demo account is so you can practice or even just look at the charts the same way I'm looking at the charts when I'm teaching you guys. It's nice to be able to pull up the platform that you'll be using. So that's the reason why that's the first step right there. Then we need to learn the trading platforms, okay? So when I first started, like I was saying, I had no idea what the heck I was doing. I had zero guidance. So you guys are already a step ahead of me with that. Your first step to becoming a trader is understanding the platforms that you're going to be using to place the trades or marking up your charts so that you can figure out what the market's going to do. Now, of course, I'm going to be teaching you how to do all this, but this is something that you need to do, the first step. So most traders use MetaTrader 4, which is the platform you can download from your to your phone in the App Store, or you can download it on the desktop. So when I download MetaTrader 4, what I do is I go to www.heyforex.com, and there'll be a link that says download MetaTrader 4. Now you'll do that with any broker you have. So if you're using a different broker, there'll be a thing that says download MetaTrader 4. That way it will download to your desktop. You can input your demo account numbers or your live account numbers into the MetaTrader 4 and be hooked up and ready to go and being able to look at what the market's doing. Now, for marking up my charts, I use TradingView, which you can go to www.tradingview.com. And the reason why I like TradingView so much is because it's so easy to use. I wish I would have used this in the beginning. I didn't start using TradingView until I think it was 2 years ago. And ever since I started using TradingView, my trading's got even 10 times better. So it just allows you to see the more overall picture of the market. You can look at more time frames. That's why I use TradingView. I personally think it's way easier to use to mark up your charts than MetaTrader 4. So that is why I use TradingView. Trading definitions you need to know. Okay, so we have many definitions that you'll need to go over. All of these things are things that I use or at least needed to know when I started trading. So let's get started here. So you'll hear me say long and short. Let's go long, let's go short. Okay, so long is the act of buying when I believe that the price or the currency price is going to rise. So in this position here, I went long on Bitcoin at 38,000 based off of my strategy, which means I believed that the market was going to buy. Obviously, it bought off that level, market moved up, and that's what happened. And that's in this little region right here. So I believed that the market was going to go up. It did, and hit my take profit, okay? Now, opposite of long is we have short. So short is the act of selling when you believe the currency's pair will drop. So if I'm in a short, I went on a short right here on Euro CAD at 1.54669. So I went short here believing that the market was going to drop based on how I see the market, okay? And obviously it did what I believed that it was going to do. Now we have the base pair. So when you see GBP JPY right here, that is the currency pair you're trading against. So basically you're trading the British pound, which is GBP, versus the Japanese yen. So the base pair is the first of the two currencies in the exchange rate. So right here, the GBP is the base pair. Now we have the quote pair. So the quote pair is the second of the two currencies in the exchange rate. We have GBP, which is of the base pair. The JPY, which is the Japanese yen, is then the quote pair. Okay, so that's the second of the two in the exchange rate. So we have the base pair and the quote pair. GBP, JPY, base currency, or the currency that you are buying when you trade the Forex pair. So let's say I am in a long position on GBP, JPY. That means that I believe that the GBP, the British pound, is going to gain strength against the Japanese yen. Now the quote currency, or the currency you are selling when you trade the Forex pair. Okay, so that's that right there. It's just nice to know this. You're going to be seeing a lot of currency pairs, and it's nice just to know exactly, the base and the quote currency. It's something that you should know as a Forex trader. Now, this is very important. We have pips. You'll hear this a ton because pips is how we measure the units in the Forex market. So you'll hear me say, oh, okay, so my take profit is 110 pips. So 110 pips is how much I believe that the market's going to go up in a specific trade that I might be in. And 110 pips is quite a bit of pips. I mean, you can make a lot of money if you win a trade, especially 110 pips, right? So what pips stands for is price in percentage. And I will tell you later on in this course exactly how you can figure out how many pips a, a, a single move is, okay? So we have bid, ask, and spread. Now, the bid is the price you can sell the currency base. So right here, I can sell 1 USD for 1.25916, right? Now the ask right here is the price that you can buy the base currency. So you can buy 1 CAD, which is Canadian dollar, for 1.25924 USD. So how I figure out what my spread is we have USD CAD bid, which means if I were to sell, this is where my position would enter it at. I would automatically be negative based on the spread that the broker charges you for the position that you're in. So I have USD CAD, and the bid is 1.25916. The ask is 1.25924. Now, if we subtract 16 from 24, we're going to get 0.08, and that is the spread of the currency pair. So when I enter that trade, I'm automatically negative 0.8 pips, okay? Now we have 3 things that matter in spread. So we have the liquidity, the more available the currency is for buyers and sellers. So when the spread it might be a little bit lower is when we have a lot of availability for a currency to be bought or sold. Now we have the size. The bigger the deal, the wider the spread will often be. It doesn't affect you too much because the broker is taking the risk on this position. Really doesn't affect you too much no matter what the size is. Now, the time of the day, the spread's going to change. So we have 4 different trading sessions, and you're going to learn about this in the next video. But during specific trading sessions, when they switch over, so let's say it's 2 p.m. here in Arizona, and the Asian session is now going to switch over. Now, when this Asian session switches over from the US or the New York session, the spread widens because the US or the Asian session does not have as much liquidity in the market or the volatility in the market. It's kind of a very slow time in the market, which is kind of midday for us living in the US. Then we have the lot size. So you'll often hear traders say, okay, I was trading 5 lots, I was trading 6 lots, or some people never trade that high. But the lot name right here, we have micro, mini, and standard. Now the micro is 1,000 units of currency, which equals 0.01, which is the smallest lot size you can use. Now we have the mini, which is 10,000 units of currency, which is 0.10, which would be $1 per pip. So let's say I'm in a long position. I go for a buy. Market moves up 10 pips. I'm in a mini size or a lot size of 0.10. Went up 10 pips. That means I made $1. Not too crazy. Obviously, it's a mini for a reason. You're not making a ton of money when you're using micros and minis. Now when it starts getting fun is when we have the standard lot, which is 1.00. And the standard lot, when you're placing a trade, let's say I place a trade at 1.00, which is a 1 lot trade, the units of currency I'm buying is 100,000. Lot size 1.00. Now dollars per pip is $10. Now the market can move very quickly. It can go up or down 20, 30 pips within minutes, right? So let's say I get into a trade. I'm using a standard lot, which is $10 per pip. Let's say the market goes up 25 pips and goes with me. I'm in profit 25 pips. I just made $250 because I am trading basically $10 per pip that the market moves. So you take this up a notch. Right now, I'm trading anywhere between 10 to 20 lots per position. So when the market moves 1 pip, it's anywhere from $100 to $200 per pip that I'm trading. So if I'm trading 10, 20 lots at a time, market moves up 10 pips, I'm making $1,000 to $2,000 right there in a very little amount of time. So this is what happens when you have a larger account size and you've been doing this for a while, you can start using those lot sizes to where you're making crazy amount of money. There's so much growth in this industry. There's really no stopping you from making any amount of money that you want to make. Um, but very, very cool stuff right here. Then we have the margin. The margin is the amount of money needed for the broker to have faith in an open position on their platform. So the percentage of the full amount of the position. Understanding your margin requirements help you understand your leverage. So margin matters really especially when you're over leveraging, which you do not want to be doing. And over leveraging means you're risking too much on a single trade. And what that will happen then is you'll get margin called. So basically, the broker can't take that risk because you're too over leveraged, which means you have too much risk in on your position. And if it goes negative against you, you might blow your account. So what will happen is the broker, to protect themselves, they'll close you out of that position once the risk starts getting too much for them. So you don't ever want to be over leveraged to the point where you could get a margin call. Then we have our stop loss. A stop loss is the price that you want to be out of the position if the trade is moving against you. Okay? So when you go long, so let's say I think the market's going to buy, I'm going to place, so here's my entry here. I'm going to place my stop loss below my entry because let's say I believe that the market's going to buy, but it ends up just keeps going down. Now what's going to happen is the market's going to come down to my stop loss and close me out of that position in a loss. Now the reason why we use stop losses is to protect our account so that we don't lose more than we should be losing. So you're going to be learning more about this throughout the course, but let's say I have a $100,000 account. I'm risking 2% of my account in this trade, which means if I lose this trade, I lose $2,000 based on that 2%, right? Well, let's say my take profit would be 8% of my account. So if I win this trade, I win 8% of my account. I'm taking a 2% risk for an 8% gain, which is awesome. But let's say it ends up hitting my stop loss. Well, I just lost that 2% of my account, and it protected me from losing more than 2%. Now, when I go short, I'm going to place my stop loss above because let's say I think the market's going to go down. Well, let's say it doesn't, comes up and doesn't follow your plan, hits your stop loss. Now you're out of that trade and protected more than you were. Stop loss for a short right here. So my stop loss is this red box in here. If it comes up to the top of this red box, that means my stop loss was hit. That means I lost money. As you can see, obviously the market did not do that. It dropped. But the red is my stop loss. You want to protect yourself. And then we have a stop loss for going long right here at the bottom of this. If the market comes down there in this position, I bought off right here. If the market comes down in this position, hits this spot, then I took that loss. So the stop loss is for protection if the market doesn't do what you think it's going to do. Then we have the take profit. So the take profit is where the profit will be closed in profit. So what this means is you're setting a certain take profit point, which you will learn exactly how to do throughout this course. When the market comes up, basically when you're in a long, you want to place your take profit above your position because we want the market, let's say I'm in a buy, we want the market to go up and hit a certain level in the market. That's where my take profit is. So it comes up, hits my take profit, and closes me out of that trade. Now, when you go short, your take profit's going to be below because we believe that the market's going to drop. So we want it to hit our take profit. And when it hits that take profit, we're closed out of that position. Winnings are now in our trading account. So now we have our take profit for our short, and our take profit is the green box. There's a reason why my take profit was set to this level, but that is the take profit for a short. Obviously, your take profit's going to be below your entry in a short. And then for when you go long, your take profit's going to be above. So right here, I believe that the market was going to go up to this level. Obviously, it did go up to this level, so my take profit was hit. risk to reward ratio. Now, this is very important. I use risk to reward and teach a lot about it because I think it's very important in trading. So the risk reward ratio, we always want our risk to reward, especially in the way I trade, to be at least 1 to 2. Meaning that if I were to lose my trade, it would only be half of what I would have potentially won. Okay, so what a 1 to 2 risk to reward ratio means. So let's say I have a $100,000 account. I'm risking 2% of my account. If I lose, the market is going to go negative against my account 2%, which is essentially a $2,000 loss. Now, the thing that I want to do to keep this to a 1 to 2 risk reward ratio is my take profit must be a 4% win of my account. So if I win, I'm winning $4,000. If I lose, I'm losing $2,000. We want our reward to always be more than what we're risking. And what this does is this keeps us profitable even if we're losing more trades than we're winning. We want our losses to be small. We want our wins to be bigger, okay? So having a good risk to reward ratio in our strategy ensures that we can lose more than we win and stay profitable. So let's say I have a trade where I'm using a 1 to 4 risk to reward ratio. What that means is if it hits my stop loss, I'm going to lose 2% of my account. If I hit my take profit, I'm going to win 8% of my account because my take profit is 4 times the amount of what my loss would be. And as you can see here, so my risk in this trade right here, so if it were to come down, hit my stop loss, I'm going to lose 751 pips. Now the reward is 1952 with a risk to reward of 1.383, which is pretty close to a 1 to 4 risk to reward ratio. And the good thing about having the good risk to reward ratio is, let's say I go on a losing streak and lose 4 trades in a row and lost 2% on my account each time. So I'm negative 8% in my account on this in the last 4 trades. Now the cool thing about having a good risk to reward, let's say my next trade is a 1 to 4 risk to reward ratio. So it comes down, hits my take profit. I just gained 8% on my account. And now it only took me 1 trade to break even. And now my account balance is back up to a break even amount. Instead of losing the 4 trades where I only lost a small amount every time. Okay, so let's say, I lose the 4 trades. I'm down 8%. But then I win 2 trades in a row that are both 1 to 4 risk to reward. Well, that means I'm up 8% on my account now, right? Which means I could then lose 4 trades in a row and be back to break even. So we want to have a good risk to reward so that we can lose more trades than we win, even though in this strategy we are going to be winning more than we're losing by far if you're doing it right. But that's just what it takes to maintain a profitable long-term strategy. Now we have some more definitions here. We have equity. Equity is the account balance plus the floating profit or drawdown. So what that means is the equity, let's say I'm in trades and I'm up $1,300. Now that's not going to show on my balance because I'm still in that trade, but it's going to show up on my equity, which means that's how much money I actually have if I were to close out of those positions right now. The balance of the account total, not including the floating positions, right? So that means that my balance, let's say that I'm in $1,500 drawdown, but my account balance is $100,000. Well, my equity in that case is going to be $98,500, but my account balance is still going to read $100,000. Now, what really matters is our equity, right? Because we could be negative $50,000 in our account, in our $100,000 account, and our balance will still say $100,000. But our equity, our true amount that we actually have in that instance, would be only $50K. So you got to be aware of what your equity is. Now we have gaps. Gaps is the space left on the chart where price jumped, and this is usually going to happen over the weekend when price happen or when something happens in the market. So let's say market closes on Friday afternoon. It closes at a specific price. Let's say let's just do a cryptocurrency here because everyone knows that. Let's say Bitcoin closes on Friday, even though it stays open all weekend. Cryptos stay open all weekend, but let's say it closes on Friday and it's at 38,000. Now, let's say some news happens over the weekend and the market's closed, and some news that would affect the price of Bitcoin happened over the weekend. Well, what could potentially happen is when market opens back up on Sunday, price could jump or it could drop based on something that happened. So oftentimes this could be a scary thing if you're in positions over the weekend, and a lot of people choose not to be for this instance. I've never had it happen to me, and I do hold trades over the weekend every once in a while, but that is something that can happen, and you got to be aware of that. And then we have some more definitions. We have volatility, and you might have heard me talk about this in this video already. So the amount of risk slash uncertainty in the size of the changes in the currency pair. So what the volatility is, the higher the volatility means the more the market's kind of moving, all right? So I personally like high volatility pairs because they move more, which essentially can make me more money, right? But there are other pairs like Euro USD, which is it moves, but it's not super volatile, right? So it kind of depends on what you like. If you want movers, you want a high volatility pair to trade. Now, Bitcoin and cryptocurrencies, those are very high probability or high volatility trading pairs because of the fact that they move in price so fast. So Bitcoin can be at 30,000 and then the next day it can be at 50,000, right? So that's giving us a ton of volatility and a ton of price movement. Then we have volume, which is the amount of buyers and sellers at the same time. And this matters. We want volume. The more volume in the market, the more volatility we're going to see. And then we have margin call, like I talked to you about earlier. The money in your account can no longer hold your positions due to the drawdown of the position you're in. So that's going to where basically the broker's not going to take the risk on your position anymore, because if it goes any more negative against you, that it could actually cost the broker money, because maybe it will cause you to go negative in your account. So what the margin call is the broker protecting itself so that if you don't, or if it does go against you, it will just take you out of that trade at a certain point so that you can't go negative. So that is the basics of everything that you need to know. And I think that you should either print off this PDF that's on the website, www.tradersociety.com, or write down the definitions, get to know it. If you're having questions about certain things, just look it up. Like, pause this, and if you're having questions about certain things like the volume, look up what is volume on Google, be more attentive to just doing it and not asking me the pointless questions like this that you could find on Google. Anyways, like I was saying earlier in this video, I'm super stoked for everything that's going to be coming out for you guys. We have so much in store for you. We're going to have podcasts. We're going to have training. I'm going to be doing live trainings or live trading. I'm going to be doing webinars with you guys. My goal with this is just to provide as much value as I possibly can for you guys. So if you have any questions, please comment on this video. Like it, share it, follow me on Instagram. I appreciate it. And like I said, guys, my goal is to bring profitable traders out into this world, give them that chance that I finally got when I started Forex. So that's my goal. I can't wait to freaking do it. I'm so excited. Now, what you guys need to do is go to that next video or take a break and kind of just let everything settle in your head, what you just learned. It might feel like a lot, but again, when I first started, I felt very slow at what I was doing, and I didn't get a good training. But I felt very slow for the first month, and then I started clicking more and more and more, and obviously to the point where it's just a second nature to me to know all this stuff. So again, very excited. Now what you guys need to do is go to that next video, and we will see you soon.
Be pulling up. Remember they said I'm not good enough. I took all the energy, turned it to greatness. Now look at my life, man, it's looking amazing. I'm ready for anything, anyone. I've been so